Okay, good evening. This is Professor Mayer. This is our chat session. I believe it's our third chat session. We are talking about this evening, we're going to be following up on some issues related to the stockholder equity. We're going to focus primarily on retained earnings. And then what I want to do is to go directly into Chapter 19, where we're going to be discussing compensation and some issues related to share price and the price per share and earnings per share, diluted earnings per share, and so forth. So that discussion is starting this evening. It's going to continue to our next class. But at this point in time, what I want to do is I want to focus on some additional material that we had covered, or we did not cover, related to Chapter 18. And I'm focusing specifically on retained earnings. So just make sure that everybody understands where we are. The assignments problems are set up in such a way that they are the exact same problems as the practice problems. The only difference is that there are different numbers. And within the assignment problems is you do have two chances to do this. The second chance that you do it, there is a deduction in terms of points. But keep in mind that you always get the highest point value, so there's never ever a opportunity, or there's never ever a situation where that when you resubmit that it would actually lower your score. Okay, and if you get 100%, then it actually won't let you do the second attempt. So I guess that would be a good thing. The idea is that you have the practice questions. Practice questions are the same as the assignment question. The only difference is the numbers are different. And what I'm trying to do is to encourage you to do the practice questions first. It's not timed, it's not anything. You just work at it. And then once you have a good handle on this, you can then begin your assignment problems. And the assignment problems is coming from the practice question base. And from the practice question base, I think you get a real good sense of what it is that we're trying to do. This is a strategy that I use in both my intermediate accounting as well as advanced accounting, and I think students appreciate the fact that what we're really trying to move forward with is a complete understanding of these problems. And if you can understand what you're doing, I think that's actually a very good thing. And in these online programs, it really is up to you to do that extra effort in terms of understanding. And what I try to do is to give you the information that will help you in terms of developing what it is that we're trying to do here. Let's continue on. And what we want to talk about is retained earnings. So let's talk about retained earnings and make sure that we understand what retained earnings are. Well, retained earnings are the accumulated earnings of the corporation since its inception. So the idea is that the first year of operation for an organization, you start off with retained earnings of 0. You increase retained earnings by creating net income, and from this retained earnings increased by net income, it's decreased based upon the dividends paid. And these dividends could in fact be stock dividends, cash dividends, property dividends, whatever the case may be. Is that what we're looking at here is we are increasing. An increase in retained earnings is a credit transaction, so we are crediting retained earnings. Just kind of keep in mind that, just understand sort of the process is net income is we have revenue, which is credit, expenses, which are debits. Those get passed through the income summary, and then income summary then as a composite number then is liquidated and moved over to retained earnings. So if you have net income, which is positive, it's a credit balance, it ends up in retained earnings as a credit balance. Now keep in mind that not every company actually makes money, so a net loss would in fact decrease retained earnings And then the question then becomes okay, so what happens if there is a situation where the company has never made any money, that they've actually have a series of losses? Well, what that means is basically that retained earnings it's still the account of retained earnings, but we call this an accumulated deficit. So a debit balance in retained earnings basically means that you've lost money. Just going back to retained earnings it increases with net income, decreases with dividends. And that's really what we want to focus on this evening, is this whole concept of dividends, dividend payments, and so forth. The question becomes, how do we actually distribute profits of the corporation to the owners of the corporation? And keep in mind that we are talking about a corporate entity. So none of this applies if we're talking about partnerships. So partnership is a totally different concept. But in a corporation, the corporation is a separate entity as compared to the owners. So when a corporation actually generates profit, the corporation pays corporate profits, taxes, pays taxes on this, and then the dividends are distributed post-tax to the owners, and then the owners pay a dividend tax. So basically what this is meaning is that the owners, from the corporation to the owners, there's this whole concept of double taxation. But let's just kind of make sure that we understand this, is dividends are paid, and these are paid based upon what the corporation is returning to the shareholder a portion of their investments. If in fact these are paid out of retained earnings, these are dividends. And let's make this sure that we understand the difference between a dividend, which is a profit, and a liquidating dividend. So basically a liquidating dividend is where we are paying out of the corporation more than the company has actually earned. So we're actually paying back to the owners of the corporation some of their contributed capital. Any portion of the dividend not representing distribution to earnings should be debited to additional paid-in capital. We won't really go into the tax situation here, but just kind of consider the fact that if you are liquidating the corporation and paying to owners more than earnings, well, that money that the owners are receiving is not going to be taxable because, frankly, it's their own money. They're getting back some of their contributed capital. Think about that for a minute, but most of what we're considering are going to be dividends paid out of retained earnings, and we do want to make sure that we understand some of the nuances related to dividends. It's possible that there are restrictions on retained earnings, and what we mean by this is these restrictions are board directed, and these basically mean that these dividends are unavailable for dividends, that the balances in retained earnings are unavailable for dividends. Just kind of keep in mind that this is really the corporate structure. The corporate structure basically is that the corporation needs to grow. Well, how does the corporation grow? Well, corporation grows from three basic areas. It grows from internal growth in terms of increases in retained earnings. It grows from issuing capital. So the capital stock is increasing, contributed capital. This increases the assets. And then the final means is actually issuing debt. So a corporation consumes a lot of cash in terms of its growth, and the issue becomes is where does this cash come from? And this cash comes from these three basic areas. A corporation certainly may have the idea that the cash and the profits of the corporation are better used by the corporation as compared to distributing these as dividends. And in fact, most startup companies and new companies really don't pay dividends because what they're looking for is they're looking for these accumulated profits to help fund future growth. If we make or define dividends or retained earnings as being unavailable for dividends, basically we understand the fact that retained earnings essentially is the means by which we distribute profits to the owners of the corporation. We distribute profits in form of dividends. If we're distributing profits, these are either going to be cash dividends or stock dividends. If we are distributing in excess of profits, this is a liquidating dividend, and liquidating dividend is something in which we are distributing the contributed capital, and essentially it's going to reduce our paid-in capital and has implications for taxes that are sort of beyond the scope of what we're looking at. But let's talk about cash dividends. And again, we're talking about cash dividends from the perspective of paying dividends from the earnings of the corporation. There's no obligation to pay dividends, and the idea is that we initially create a liability when the board of directors votes to declare a dividend. So when the board of directors votes to declare, this is the declaration date. Essentially what's taking place is we are debiting retained earnings and we are crediting the dividends payable. In the next process after this, what's taking place? So before the payment is actually made, a listing must be assembled of shareholders entitled to receive this dividend. And this is really what we're talking about of the date of record. So keep in mind that there is several weeks, maybe a month or two, between the declaration of the dividend and the actual payment of the dividend. Within these two dates is what we call the date of record. This is the date of record to identify the individuals who should receive the dividend. It's a specific date, and identifying who's receiving the dividends. Just kind of keep in mind that especially publicly traded stock is traded tick by tick, minute by minute. Just because you own the stock when the dividend is declared doesn't mean you're going to get it. The people that get it are the people that own the stock on what we call the date of record. Now, the date of record doesn't require a journal entry. The date of record, essentially what we're looking for here is a drop-dead date, so to speak, that identifies the people that are actually going to receive the dividend. And then finally, what's going to take place is, investors purchase the share before what we call the ex-dividend date. The ex-dividend date is the date of record. Cash dividends, June 1st, the Board of Directors of Kraft Industries declares a cash dividend of $2 per share on its 1 million shares payable to shareholders of record June 15th to be paid July 1st. So the date of declaration is June 1st, the date of record is June 15th, and the payment date is July 1st. So the initial date in millions is again, we talk about this, it is a debit to retained earnings because we are reducing retained earnings, and the credit is going to cash dividends payable. The declaration date and the ex-dividend date, there are no entries, and then the payment date is we debit the dividends payable and we credit cash. Ellsworth Corporation was organized on January 1st, 2016. The firm was authorized to issue 150,000 shares of $1 par value stock. During 2016, Ellsworth has the following transactions. Issued 20,000 shares of common stock at $7, issued 20,000 shares of common stock at $8, report net income of $100,000, paid dividends of $50,000, purchase shares of treasury stock of $10. Total stockholder equity, just kind of keep in mind that we'll show the answer in just a minute, but issuing stock at $7, that's going to increase our common stock, additional paid-in capital. Issuing 20,000 shares of common stock at $8, increasing common stock and additional paid-in capital. reporting net income of $100,000 increases retained earnings, paying dividends decreases retained earnings, and purchasing of the treasury stock is going to decrease our total stockholder equity. So we'll go through this transaction. What we're going to see in this case, what we're looking at is we're looking at 20,000 shares at $7, 20,000 shares of $8, net income $100,000, dividends and retained earnings reduces it, and we have our answer of $320. Property dividends, a little bit different. When we distribute a property dividend, keep in mind that what we're attempting to do here is we are distributing this at market value. Embedded in the transaction is going to be a gain on the transaction. So what we're doing is we're recording these transactions at fair value of the asset. And the difference between the fair value and the adjusted book value is going to be a gain or loss in the transaction. And you'll see this, and it's kind of interesting how this transaction actually takes place. On October 1st, the Board of Directors of Kraft Industries declares a property dividend of 2 million shares of Beekman Corporation's preferred stock that Kraft had purchased in March as an investment. The book value of this is $9 million. The investment share value of $5 per share is $10 million. And the payable to the shareholders of records is October 15th to be distributed on November 15th. Okay, so just kind of keep in mind that we have a difference there between the $9 million book value and the $10 million par value. What's taking place here is in millions is on the declaration is that we are reporting essentially the cash dividend payable at the market value. Now, embedded in this is the 2 million at $5 per share. So the 2 million at $5 per share essentially creates the transaction that we are reporting this at the market value. And what we see here is that what we're looking at here in this first transaction is we are increasing the value of $1 million, the difference between $9 million and $10 million. That's what you see here is the investment in the preferred stock increases and the credit balance is going to our cash dividend payable. And then what we're looking at is retained earnings is reduced by the $10 million, which is the fair value. October 1st, Board of Directors declared the $2 million of Beekman's Corporation. Okay, so we have the book value of $9 million and the par value of $10 million. And what we're seeing here is that on the declaration date is we are creating a gain on the appreciation of the investment. So again, internally, we're creating this gain, so we're paying taxes on this gain, but the idea is that it's distributed at fair value to the owners, and the owners of the corporation are essentially going to be paying taxes on this based upon its fair value, not upon its book value, which becomes a very interesting phenomena in the sense that if you are a small corporation, you have a business, you have a small corporation, it's actually very unwise to use the corporation to buy the assets, because as these assets appreciate, property or whatever, there's going to be a corporate tax, and then those gains are going to be distributed to you, and then you're going to have to pay a capital gains tax on this based upon the dividends. It's much better, so you have a small business with a corporation, much better for you to individually buy the asset and then lease it to the corporation. And frankly, if you structure this correctly, is you have just a tremendous tax advantage through the life of the asset, and then at the end of the asset when you're trying to sell it is you don't have to pay this double taxation. So what's being described here is the asset is embedded in the corporation, owned by the corporation. We sell the asset, but what we want to do is want to give this back to the owners. Okay, so not much you can do. It's a large corporation. This is a small corporation. Basically what you're looking at here is probably a bad transaction. Anytime you want to start a corporation, start a business, two things that you need a tax advisor, you need a lawyer, and you need to think through your decisions, because frankly some of these decisions, if your corporation, if your company does well, is you are going to actually pay a significant price to this if you're not structuring the corporation correctly up front. But this is basically what's taking place, is the corporation creates a gain on the asset, and then the asset is distributed at fair value to the owners, and the owners are then paying a dividend tax on this distribution at the fair value and not the book value. Property dividend payable and the investment in the corporation tax essentially is the final transaction. Okay, now we're going to talk about stock dividends. Stock dividends are kind of interesting in the sense that they're not really creating value, in the sense that you're not getting cash, you're getting additional stock. However, your percentage ownership of the corporation doesn't change. From a corporate perspective, one of the things that a stock dividend does is it actually removes money or value from retained earnings and moves it over to additional paid-in capital. So it's very interesting in terms of the structure, and the idea is that many times a corporation will issue a stock dividend with the idea that it is attempting to give the illusion that it's actually paying a dividend, when in fact it really is not. But again, it does create the scenario where it moves money out of retained earnings. So next year when you're expecting a dividend, it's saying, oh, look, there's no money in retained earnings. The money was there, it just got moved over to our contributed capital section. So it affects neither assets because there's no cash, doesn't affect liabilities. What it only does is affects our equity section. So it's essentially shifting from retained earnings to our contributed capital. Proportional interest remains unchanged. Market price per share will decline in proportion to the increased shares. So if you're looking at the market price, it will accommodate any changes. Early rule makers felt that market prices do not adjust in response to an increase in number of shares. And frankly, one may think that there could be an arbitrage situation related to this, but again, this is not a financing class. We're really looking at this from the perspective of transaction. Capitalizing retained earnings for stock dividend artificially reclassifies earned capital as invested capital. That's what I'm saying. It moves money from retained earnings over to our accounts of contributed capital. One of the things to keep in mind is that there are what we call small dividends and large dividends. So a small dividend is going to be something less than 20%. And when we do a small dividend, what we're looking at is we're looking at the market price of the stock. When we're doing a large dividend, we're actually looking at the par value. So in this case, we're distributing 10%, a small dividend, and the stock price is $12. What's taking place here is we are reducing retained earnings, increasing common stock and paid-in capital in excess of par. And you notice how we are making this transaction based upon the market value, because this is what we call a small stock dividend. In this case, what we're looking at is 10%. So 10%, 10 million shares. So we are taking this money out of retained earnings based upon the market price and then moving this proportionally between common stock and paid-in capital. 10 million shares at $12 per share, 10 million shares at $1 par, and the rest of it is going to go to paid-in capital. Company tries to give shareholders the illusion, notice I used that word earlier, that they're receiving a real dividend, but trust me, they're not receiving a real dividend. Merely to enable the corporation to take advantage of the accepted accounting principles of capitalizing retained earnings. And again, what this is doing is it's shifting this money. You know how we talked earlier, how that we can actually restrict retained earnings. Well, this is not really a restriction of retained earnings, but basically it does the same thing, because once you take it out of retained earnings, it's no longer in the pool of money that's available for dividends. Stock splits are just a large stock dividend, and the stock split could be 100%, could be 150%. There could be reverse splits where it's a 1 for 2 with the idea that they're trying to increase the price of the stock. But in any event, it's to induce share price to decline, and motivation for reducing the per share price is to increase the stock marketability by making it more attractive when the market is, especially in a rising market, and we saw this 1990s, early 2000s, frankly recently, is the fact that what we're looking at is a company, once the stock price reaches over $100 per share, it's perceived that the stock price is out of range for the normal investor. So what happens is they'll split, cut the price in half, and now the marketability of the stock actually increases. So a stock dividend doesn't do anything other than cutting in half the par value of the stock, but there's absolutely no impact on the actual equity section in a total value perspective. So we have the example here. Company declares 100% stock dividend on 100 million shares of common stock with a par market price of $12. It then has 200 million shares with an approximate market value of $10. Again, the par value actually decreases. A stock distribution of 25% or higher can be accounted for in two ways. So the range is 20 to 25%. We call this a large stock dividend, and we consider this as a stock split, or we would consider this as essentially what we're doing is we would then do the transaction but at par value and then take it out of retained earnings. But if we call it a stock split, essentially what's taking place is it is not going to affect retained earnings. Essentially is the par value is going to be cut in half. The issued shares, authorized shares are going to double, but there's no effect here. Let's see, what we have here is a split in the form of a stock dividend. Declares a 2-for-1 stock split effected in the form of a 100% stock dividend when the market price is $1, par value $12 per share. And essentially what's taking place here is we are going to debit the paid-in capital in excess of par by this $100 million and increase our common stock. Now, corresponding to this is what we're seeing here is we are debiting retained earnings at the par value and increasing our common stock at the par value. I want to at least get us started in terms of what we are considering, and we have actually a sort of a potpourri of activity related to Chapter 19. So what we're looking at is we're looking at share-based compensation and earning per share transactions. So we're going to be doing a lot of different things in Chapter 19, and I at least want to get us started in terms of some very specific problems. Okay, so Chapter 19 actually is coming, some of these problems are actually coming from the old textbook. but you'll get the idea in terms of what it is that we are looking at here. One of the things that we're looking at, that we're considering in this chapter, is the convertibility of bonds, and we're ultimately going to be looking at the convertibility of these bonds as they affect the earnings per share. For each of the unrelated transactions below, present entries required to record the transaction. So in this case, Coil issued $10 million par value, 10% convertible bonds at 99. So we issued these at less than par. If the market had not been convertible, the company's investment banker estimated that it would have been sold at 95. Expenses of issuing the bonds were $70,000. So you notice here at the bottom is the issuing cost essentially is a cost. So the question becomes, is how much of this convertible feature is related to the bond, and should it be separated? Well, what you see here is these are convertible bonds. If the bonds had not been converted, the investment would have been sold at 95. So the issue becomes is that 95 becomes irrelevant because this is not a feature of the bond that can be separated. So in this case, what's taking place is that we are issuing the bonds at 99. We have bonds payable at $10 million, discount on the bond of $100,000, and we receive cash at 99% of the $10 million. Okay, so that's an easy transaction. It's kind of a sort of a hook related to that in the sense that the convertibility is not a function that's actually separate from the transaction. Different as compared to what we see here. Lambert issued $10 million of par value, 10% at 98. One detachable purchase warrant was issued with each $100 par value. At the time of the issuance, the warrants were selling for $4. So in this case, what we're looking at is we are considering the fact that there is a value, and again, these are detachable warrants. So these are essentially, we're selling these, but we're selling these from the perspective that we are going to, these are separate items. So we are actually going to have these as separate items on the balance sheet in the equity section. So interestingly enough, we do not have the value attributed to the bond. We do have the value attributed to the warrant. This is not a pro rata distribution. Essentially, we take the number that we know. The number that we know is the $4 for the warrants. So essentially, it's the $10 million divided by $100 and times 4, so that's $400,000. We are issuing, in this case, the total package for 98, which is $9,800,000. We separate the $400,000 from that, and we identify the value of the bonds at $9,400,000, which means that there is a corresponding discount associated with this of $600,000. So you see this transaction on the top here. So ultimately, we're receiving $9,800,000. We still have a bond payable of $10 million. The value that we know is the value of the warrants. You notice it didn't give us a value of the unattached bond, so we don't know that. So essentially we back into that number. So we back into that number, we get the $9,400,000, which means that the discount on the bond is going to be $600,000. Sepracor called its convertible debt in 2010. Assuming the following related transactions, the 11% or $10 million par value were converted into 1 million shares of $1 par value common stock on July 1st, 2010. On July 1st, there were $55,000 of unamortized discount applicable to the bond, and the company paid an additional $75,000 to its bondholders to induce the conversion of the bonds. So let's just kind of look through this transaction. So when we convert the bonds, we're converting these bonds at our book value. So we're not concerned with the market value of the stock or the market value of the bonds. We are essentially converting everything from a book value perspective. So a couple of things here. You notice that the debt conversion expense is basically separated. Frankly, it would be easier if the debit to debt conversion expense and the cash paid for this of $75,000 was in a separate transaction, but you see it really doesn't affect the rest of the transaction. But what you see here is that the bond payable is removed because we're converting this $10 million. The discount is removed. The remaining discount is $55,000. That's removed. And then the remainder is then allocated to common stock and par value. Common stock is the par value of $1 million, $1 par value common stock times the 1 million shares. And then everything else, sort of the plug number, so to speak, is going to go to paid-in capital in excess of par. So we're not at all concerned with market value. This essentially is a transaction we're converting. We are essentially removing the bond payable, removing any discount or premium, and the remainder is going to go to common stock and paid-in capital. Common stock is going to be at par value, and the remainder is going to go to paid-in capital in excess of par. This is actually kind of interesting. I will tell you that a lot of students really struggle with these transactions, and we'll actually go through, not necessarily tonight, but at least over the next, this week and next week, a number of these transactions that I think will sort of enlighten you. By the way, I think I will post for you, and I may have actually already posted this, one of our lectures specifically related to this chapter 19. Again, it's chapter 16 from the old book, but the transactions are basically the same. Okay, Gauguin uses a calendar basis for financial reporting. The company is authorized to issue 9 million shares of $10 par value common stock. At no time had Gauguin issued any potentially dilutive securities. Listed below is a summary of Gauguin's common stock activity. What we're looking at here, the number of outstanding shares, so we don't actually have the question yet, but this was as of December 31st, 2009, 2,400,000 shares. Shares issued as a result of a 10% stock dividend on September 30th, 2010, 240,000. Shares issued for cash on March 31st, 2 million. And the number of common shares issued and outstanding as of December 31st, 2011 is $4,640,000. A 2-for-1 stock split took place on March 31st, 2012. What we're looking for here is we're looking for computing the weighted average number of common shares used in computing the earnings per share for 2010 on the 2011 comparative income statement. So let me go back here. So we're looking at the comparative income statement for 2011. So you notice in 2011, the beginning of the year, we had 2,640,000 shares, and then we issued an additional 2 million shares. Okay? Now, the question becomes is how do those actually compare to prior years? What we're looking for here is on January 1st through September 30th is we had, and we're doing this pro rata distribution, is we had 2,400,000 shares, but we only had that for 9 months. So 9 divided by 12 is 1,800,000. Retroactive adjustment of 1.1, because again, keep in mind that 1.1 represents the 10% stock dividend. So that increases this to $1,980,000. And then the rest of the year we have $2,640,000, but we had that only for 3 months. So what we have in 2010, these numbers here, 2,640,000 shares. So the 2,400,000 shares at the beginning of the year must be restated for the stock dividend, regardless of where in the year the stock dividend actually occurred. So in this case, what we're looking at here, compute the weighted average number of common shares in computing earnings per share of common stock for 2011 on the 2011 comparative statement. So what we're looking at here, so there were no stock dividends, but essentially what we're looking at is we're looking for a weighted average. So within the first part of the year, 2,640,000 shares, but we only had that for 3 months, so 3 divided by 12. And then the rest of the year, you remember we issued an additional 2 million shares, so it's 4,640,000 times 9 divided by 12 is 3,480,000. So what we have in 2011 is the 4,140,000 shares. That's the transaction. So those are the comparative outstanding shares that are going to be used in the calculation of the earnings per share. Compute the weighted average number of shares to be used in computing earnings for 2011 on the 2012 comparative statement. So what we have here is the weighted average of shares as previously calculated as the 4,140,000 shares. We readjust this for a stock split. So that's going to be 8,280,000 shares. Compute the weighted average number of common shares to be used in computing earnings per share for 2012 on the 2012 comparative statements. So what we've got here, and let's just kind of go back here and make sure that we understand what's taking place in number of outstanding shares as of 2011 is 4,640,000 shares, and then the stock split occurs on March 31st, 2012. So we're looking at this. So January 1st to March 31st is 3 months. So the 4,640,000 shares times 3 divided by 12. We do the retroactive adjustment, stock split. So as adjusted, that's going to be 2,320,000 shares. April through December is the 9,280,000 shares, but we do this 9 divided by 12, $6,960,000, and we end up with the weighted average shares for 2012 of $9,280,000. So we've covered the material. We've been talking for about an hour. So I thank you very much for your time. I thank everyone for their time and attention. I certainly appreciate your efforts, and we will talk to you in 2 weeks, okay? So thank you very much, and everybody have a great night.